Tell us about yourself, Ryan.
Sure. Yeah, I'm Ryan Joyce. I'm a certified financial planner and CPA. Been in the business for about 16 years now. Been doing 1031 exchanges for the duration of that time. And, I'm here partnering with Dan to help you guys understand the 1031. I think Dan's going to take you through some good mechanics, and then hopefully with some of the experiences that I've had and the background with regard to the tax and cash flow financial planning aspects of 1031s, we can give you guys some tools for your tool belt in terms of being a valued partner to all of your clients.
Thank you. And one of the things I wanted to also highlight, Ryan and Annie, I wanted to first of all thank you, Annie Quintelis, for organizing this for us. I believe you said there's 250 people that have registered, and we're excited to have everybody here today. I also wanted to highlight Tiffany Wu in terms of commercial. Thank you. The best CEO in the world is Travis Kessler of the Texas Association of Realtors. Chairman Cindy Bulla. We love you, Cindy. Trey Bates, another great leader. We love you. And Leslie Ruda Smith. Of course, Texas is so proud that you're going to be leading the nation at the National Association of Realtors. So we're proud to be a part of Texas today. One of the things I want to highlight before we get into all this is the 1031 like-kind exchange has always been attacked for the last 100 years. It's been in our tax code, and thank God we're able to keep it in the tax code. Right, Ryan?
Absolutely.
Very, very important. And one of the reasons why is because of this pen that I'm wearing. It's RPAC pen. I really commend the Realtors for having over 10,000 people walking Capitol Hill to save the 1031. And it happens not by chance, but by everybody working together. And if you haven't donated to RPAC, please consider doing that. It's really the best investment you can make. It's basically our insurance policy as Realtors. So I'm honored to be a Realtor. I'm the past president of the Chicago Association of Realtors, super involved with Illinois and at the national level. So we love the organization, and we want to get into this very important topic about the 1031 like-kind exchange. So without any further ado, let me give you just a quick primer of the Inland Real Estate Group. So I work at the Inland Real Estate Group. I'm talking to you from Oak Brook, Illinois. It's about 28 degrees. And I think, Ryan, you said, what is it right now there? It's
I think we got about mid-50s, which is certainly winter here for Texas.
Yes, yeah. Well, and now with this crazy, health situation that we all find ourselves in, it's really good to be able to come together. It's really our Realtor family that we want to just say, everybody stay safe, take care of yourself. And it is kind of strange. My hair is as long as it's ever been in years. So I miss my barber, but I think I can handle it. So some of my kids want to try to get some scissors, and I'm a little nervous. But let's get started with this. Ryan is an expert in this stuff, and Inland Real Estate Group is too. So Inland, I'll give a quick elevator speech. We were founded by 4 Chicago public school teachers who came from absolutely nothing. We had them decide in the summertime to start getting investors through the Chicago public school teachers that they knew, gave them money, and they built a house and they flipped it and they gave everybody a profit. And from that, everything just really grew exponentially to the point where these teachers left teaching and they were full boat into the real estate business, where they were actually got up to 40,000 apartments in downtown Chicago. We were the largest landlord in Chicago. Walter Payton was our spokesperson. And in the 1980s, people will remember that the tax laws changed. And what happened is limited partnerships no longer could be passed through. So a variety of those partnerships were underwater. And these 4 teachers would not allow any of their fellow family, friends, and other teachers and principals that they knew to have a loss. So they went to Walmart and they asked Walmart if they could do sale leasebacks. And so Walmart agreed, and Inland overnight became the largest landlord for Walmart. Secondly, they went to Treasury during that same time and they asked Treasury, can we 1031 like-kind exchange these bad investments or these underwater investments because of the tax law? Can we 1031 these investors into these Walmarts? And Treasury said, well, nobody's done that before, but okay. So they did all that and people were saved. The 4 teachers took control of the properties that were underwater, and they put everybody and made them whole. And from that, that ethical thing to do really grew the company exponentially to where now Inland's purchased over $47 billion worth of commercial real estate. We've owned and managed properties in every state except Alaska. And we've had just hundreds and hundreds of thousands of investors. So we know how to manage property, run property, and that's Inland. So we created, from this experience of the Walmarts, our guys came together, Mr. Goodwin did, who's our chairman, and went to Treasury, and they said, let's create this thing called the Delaware Statutory Trust. And that's what we're going to get into, how the 1031 like-kind exchange can grow your business through the Delaware Statutory Trust. So we're going to start the process now.
Dan, let me jump in real quick, if I may, just a little bit more color on my background. I am an independent advisor here, so as much as I appreciate and thank Inland for including me on this webinar, my role here is to provide my experience and some independent perspective as to the 1031, some of the nuance with regard to the tax law, how you can incorporate a DST into that strategy in the appropriate manner for your client. So wanted to make sure that the attendees knew that I was not affiliated with Inland, and hopefully you guys, as you send in your questions, know that I have an independent background and looking forward to giving you guys some good advice on this webinar.
Well, Ryan, you have your securities license, so you're regulated. Tell them who you're regulated by.
Right. So we have our securities license, so we're regulated by FINRA, as well as we are an RIA, a registered independent advisor. So we have SEC registration there as well. So we are bound by the fiduciary rules of both entities to do what is technically called in the best interest of the client. A lot of you guys might be aware of that with some of the new laws that have come out. So again, that's, we really abide by the fiduciary standards in all of our practices, especially when it relates to 1031 transactions.
Yeah, and I have my besides my real estate license, I have my securities license, Ryan. And so what I'm able to do is I can talk about what Inland does, but I'm not allowed to get into the details like you can. So it's a great tag team that we have here today.
Absolutely.
So, jumping into the 1031 like-kind exchange, like I said before, it's been a part of the tax code for over 100 years. And it's, in my opinion, and what we've talked about, it's kind of like a 401k of real estate, where you're able to exchange your real property for like-kind real estate. You use all the proceeds from the sale of the property for the purchase of replacement property. And the like-kind real estate includes really everything except your primary residence. During the tax law change this past couple years ago, they did get rid of personal property, right, Ryan? So it's just real property.
That's right. And Realtors actually really came out smelling sweet on the new tax laws from 2017 because, as Dan just mentioned, they narrowed the qualified properties to real property with that tax law change.
Well, and Realtors, because it's real property, we're probably in the best position to explain what a 1031 is to our clients, and really to know that the seller can't reside in the property, that this is something that it's a total separate thing from where their house is. But doing a 1031 exchange is not additional, it's not really hard work for a realtor. It's really the qualified intermediary that does a lot of the work. And Ryan, do you want to mention what the qualified intermediary does?
Sure. So I always reference a qualified intermediary as a specialty title company. And what they do is they have all the paperwork first and foremost that's required for the 1031 transaction. They work hand in hand with your title company as in a normal transaction, and again, making sure that all the I's are dotted and the T's are crossed relative to that paperwork. I think the most important concept to understand about the qualified intermediary is that to comply with the 1031 rules, they actually hold your client's assets during the exchange. So as you probably know, to comply with the 1031 laws, there has to be no constructive receipt of sales proceeds by your client. And so that's why it's so important to select a qualified intermediary that is reputable, has insurance, and really knows their trade. And I think one other comment I'll make on QIs, qualified intermediaries, is when you're doing your diligence and recommending a QI to your client, make sure they have CPAs and CFAs and licensed professionals on board so you can really look at them as a trusted and knowledgeable partner in this transaction. It'll do you in good stead during this transaction.
So Ryan, how many times has a realtor called you to say, hey, my client sold their property, they want to do a 1031?
Too many, unfortunately. And one of the real keys there that Dan's alluding to is that when you want to engage in a 1031, you have to do that prior to the sale of the relinquished property. You can do that, and I've done it literally 30 minutes before closing. It can happen that quick, but obviously you want to do it well in advance and identify that QI prior to the sales contract going out.
Okay, good, great discussion point. So now this is going to be an example of how the 1031 is really like a 401k real estate. So you see with $1 million property, after you pay your taxes and all the, tell them all the different taxes that usually comes out of a sale of property. They know it.
Sure. Yeah, there are a number of tiers. You have the capital gains tax, both on the federal level and potentially the state level, and you have the 1250 depreciation recapture tax. And a lot of times, because of the size of the deal, you're going to then include other types of taxes, like the 3.8% Medicare surcharge, the Affordable Care Act, that is taxable on investment income. So there's a lot to be considered there, and a number of different tiers that you need to be aware of, and your client needs to be aware of in terms of avoiding all those taxes through a 1031 exchange.
So without a 1031, you sell your property and hey, you get $686,000 to invest. Well, guess what? If you do a 1031 exchange, this is like the 401k of real estate, you get the whole $1 million that you're able to utilize. So that's the funds available for reinvestment, and that's huge and super important. As we go through this, one of the other things I wanted to highlight, the typical exchange for DST, the exchanger sells the property, and you're able to put all of that money to the qualified intermediary, and then the exchanger receives the beneficial interest in DST that's identified. And so we need to go into explaining what the DST is. And the Delaware Statutory Trust allows multiple investors with the percentage of beneficial ownership varying from one investor to the next. They qualify first as a replacement property for 1031 exchange. There's multiple investors, and then they delegate the management responsibility to the sponsor, like Inland. Yep. So we used to have these things, well, there still exists, but kind of a clunky way for people to invest is through tenant in common. And now that's become really passe, and it's very difficult as far as managing it. It's not a good tool. The ownership structure for a DST is different. You get a percent of the beneficial interest, and in a tenant in common, it's the undivided TIC interest. Ryan, do you want to talk about how the pass-through works, like with depreciation and stuff here?
Sure. So with a DST investment, typically that income will be recorded on a client's Schedule E. 1099 tax forms are sent out on an annual basis, just like most other investments. It's important to know that it's not like a partnership where your client's got to wait on a K-1, and your investors will really appreciate that. As you guys know, some of them really want to file on time, and the 1099s are required to come out earlier in the year than the K-1s. And what's really important also about the nature of the income is that when you report the income on your Schedule E, you also report all the expenses associated with that investment. Those expenses can be everything from mortgage interest, depreciation expenses, administrative management expenses, and that makes for a very tax efficient type of income for your clients, because the income comes through, the expenses are deducted, all on your Schedule E, and that net income is then rolled up to your 1040, which is what is calculated for your clients to pay taxes on. So in a theoretical example, if your client is earning $100,000 of income on a rental property, it's structured in a DST, they get their 1099 that shows their depreciation expense and their mortgage interest and so forth. And at the end of the day, they're able to deduct, say, $30,000, $40,000, $50,000, depending upon the expenses associated. Therefore, they've just sheltered $50,000 or half of their income and only reporting the other $50,000 on their 1040. That's
great. Thank you. And then the other aspect that we want to get into is the loan responsibility. So the Delaware Statutory Trust, the investor is not responsible for the loan, but tenant in common it is. highlight the importance of that, Ryan.
Yeah, absolutely. So a lot of times in a 1031 exchange, the clients are looking to move into their retirement years or things of that nature where they either don't want a loan or can't qualify for a loan. And the beauty of a DST is that the portfolio is already created. It's already purchased. The financing is already done, and it's done at the trust level. So it's a non-recourse loan for your client. And again, when your client, if they sell something in a 1031 exchange as part of a 100% tax deferral, they need to replace the debt that they had on the relinquished property. And they can do that very succinctly in a DST by looking at the offering documents, the PPM, the private placement memorandum, and they'll see the loan to value there. They'll see the actual amount that will be attributable to them. And for you and their advisors through the 1031, they can really pinpoint the debt level that they need for that DST to shelter 100% of their sales proceeds on their relinquished property. I just, maybe I'll profile one quick item here. Inland has a product out. It is a zero coupon DST that is the headquarters, the U.S. headquarters for Zurich Insurance in Chicago. And what's important about this property is the loan to value. It's actually levered to a point of 80% loan to value. And what does that mean? That means that if your client has a property that they're selling, say it's $1 million property with an $800,000 note on it, that's a massive size of debt that they need to replace on their replacement property to shelter all their taxes. And that'd be hard to find out in the marketplace. Well, with a DST of this nature, like the Zurich property, they've levered that up to accommodate these types of 1031 exchangers that need that kind of debt level.
And speaking of debt level, we also have a variety of other debt levels. We have some that have no debt. So it's important to understand that. You did a great job explaining that, Ryan. Thank you.
Well, appreciate it.
The other aspect of investor property management, to me, one of the best parts of these things, of DSTs, is that you get rid of the toilets, trash, and tenants. You are not responsible for managing the property. And so that is terrific compared to a TIC. And then the other thing is the maximum number of investors. This is a really big deal because you can have up to 1,999 investors with the DST. Tenant common is 35. I think with Inland DSTs, the average is about 500 investors. Because I believe, Brian, what do we do? How much can people invest into a DST? What's the minimum amount?
I mean, usually it depends on the property. I've seen between 25,000 and 100,000. So you'll see a high number of investors. One quick point I wanted to make as well, just the comparison between the DST and the TIC, is the management. If anybody's been involved with a TIC investment, trying to get all the members to agree upon a process or a sale is like having an act of Congress. And with the DST, it has unified management. So the management is a professional group that is in the professionals in the real estate business, so they can make informed decisions for your clients, and they can do it succinctly. You don't have to wait for all 20, 25 TIC members to sign their notice to agree to any movement you want.
Well, and Ryan, that's a really good point, because the other thing is these properties are held for up to 10 years, but usually the average is what, Ryan?
Yeah, I've seen usually between 3 to 5 year holds, and it depends on the type of TIC that you have. There are multifamily TICs, there are office TICs like the Zurich deal I had mentioned, there are necessity discount retail TICs. They're all different types, data warehouses, storage units, and so forth. And they have different life cycles like every different type of investment. But when I talk to clients, I usually say it's a 3 to 5 year hold within these DSTs. And then you have the opportunity, based on what the DST management decides to do another 1031 exchange, which I think Dan has some slides ahead about the estate planning aspects of doing 1031s at multiple times.
Okay, and we're going to move on to the next slide. So the phases of a DST, the first phase is we have to do the acquisition process and the underwriting. That's a really big deal. I'll tell you from Inland standpoint, like the four teachers are still running the show here. And Joe Cosenza is in charge of acquisitions. Joe's dad was a barber, and but he has learned so much in the business. He's 52 years. So Joe's done 3,700 individual commercial real estate deals. If there was a Guinness Book of World Records, Joe Cosenza would win because he's purchased the 47 billion for Inland. And what that means is that he's able to know all of the deals that might not be out there in the market, because he knows the people that run all the different targets or whatever it is. We know everybody. And so that's where you get really great due diligence. That's where we have an entire division that just does property taxes, that does insurance. It really looks at all aspects. And when you're trying to do due diligence yourself as a realtor for your client, it's difficult to find that property and to go through all aspects of it. So that's what Inland takes that away, and that's a big deal. Then the second phase is running the property. So again, we've managed and run properties all around the country. We had, like I said before, at one point we had 40,000 apartments in Chicago. I think in total we've managed about 80-some thousand apartments. But we have all aspects of real estate that we run and know how to do. So running it is a big deal. So you're able to get the most money for your investors, and that's key, and that's what we're all about. And then, of course, the disposition and liquidity is a big deal. And we could talk about, do you want to talk about the liquidity right now, or do you want to move on, Ryan?
Let me actually make a comment, if I may, just about the due diligence process. I find that to be one of the key benefits of a DST. You really have 3 levels of diligence, right? First, you have, as Dan pointed out, the diligence at the sponsor level. Inland's going through with all the professionals that have decades of experience running the pro formas, knowing the local areas where the real estate is, so forth and so on. So you have that first level of diligence. The second level is you have the advisory, somebody like myself, a licensed security professional that's looking at this on your behalf and for your client and giving you my opinion. When I look through the pro formas, when I look through the lease agreements, when I look through the other diligence environmental studies, I can give you my perspective, a different perspective as to the security of this investment. Third level is typically a third party, and the one that comes to mind is FactRight. FactRight is a third-party due diligence organization that will put out a very detailed report on most of these DSTs. I find that invaluable for me to go to because they have their level of professionals that look through that. And then, of course, the fourth level is you. Going through and making sure that you understand what we have conveyed to you as the merits of this investment, and do they fit with your client's interests? You know them better than anybody. You know what they're looking for in an investment. So I find that the comfort of those different levels of diligence just exceptional. My clients always say to me, Ryan, I want return of my money first, return on my money second. Put me in something that is investment grade, that you feel comfortable with. Inland's got a very nice lineup of that type of investments. And to be fair, there are other DST sponsors out there that have different products. Again, it's just what fits your client best, and having the people around you to find that right DST for your client.
Very well said. And the aspect of the disposition and liquidity, I think, is a big deal for people, letting them know, what to expect with a DST.
Yeah, that's right. So, again, the time frame, people always ask me, it is on average, I would say, between that 3 to 5 year period. Sometimes it's longer, sometimes it's shorter. It just depends on the economic cycle. We had a number of DSTs that I'm involved with Inland on the multifamily side come full cycle recently. Then what's important about that is when you have these sales, you have the opportunity, just like you did going into the DST, to 1031 exchange. And what can you do? You can 1031 exchange into a local piece of property. If for whatever reason you didn't have that opportunity on the first 1031 exchange and you wanted to get something local, you could do that. Sometimes there are public offerings that are associated with these exit strategies. And then, of course, there's a next level of DST that Inland and, again, other sponsors are constantly putting out to make sure that there's inventory for 1031 investors to look at. And let me just ask you, Dan, is it appropriate now to talk about the estate planning aspects of the transfer, or we want to wait?
We're going to wait for that. We're going to wait for that.
Okay.
With the time, we're going to move on a little bit. So we have phase 1, acquisition, that we talked about, and this is where Ryan did a great job. Phase 2, running the properties, and phase 3, the disposition and liquidity. Okay, so again, there's many types of real estate that qualify for tax deferral exchange. So a duplex can be exchanged for vacant land. I mean, it's a really you want to identify with a 1031 like 3 properties, and then of course all the different types of we have industrial, student housing, office. We have all aspects of real estate. And when Ryan talked about it's never too late to do a 1031. You said, Brian, you had 30 minutes before it is due. So
Yep.
that's a really big deal.
Yep. Was able to do that. And just as a point, working with a good qualified intermediary helps this significantly. Let me throw out 2 names, if I may. IPX 1031 and Asset Preservation are 2 of the larger players in that industry. You really need a good QI in any transaction.
And the picture on there shows it's a multifamily in Dallas, Texas. So we actually own a lot of stuff in Texas. It's a good place to invest. So let's see here. It went to blank. I don't know why it went blank. That's interesting. Huh. Well, what I can do is talk. We can continue to talk. I don't know why this just went blank.
God bless technology, huh?
So I'll go to the next slide because there we go. There was that slide. Okay, never too late to exchange. It just went blank for some reason. So I don't know why, but I have everything in front of me on another computer, which is good. Let's just talk about real quickly the 1031. You have day 1, you sell your property, and then Ryan, we have 45 days to find a replacement property, and by day 180, we have to close on the new property. So it's important to realize that with 1031s, you have these really finite dates. With this crazy health crisis, the IRS just came out, Ryan, and tell them the change that they've made.
Yeah. So there's actually a clause, if you will, in the 1031 law that's allowed for disaster relief. And long story short, if you had a 45-day ID deadline or your 180-day closing deadline come between April 1st of this year and July 15th of this year, you can extend that deadline to July 15th of this year. So if today is the 14th of April, if tomorrow, the 15th, your 45-day deadline is up and you're panicking because you don't have a property for your client to go into, don't worry, you just got a really nice extension into July 15th, because of the COVID-19 issues that we're all having to deal with these days.
Okay, and luckily that came back here. We're going to talk about the QI. Again, it's super important to have someone with that's bonded, that understands, that are trustworthy, like you said, IPX 1031, because you can have, there's unfortunately people in the marketplace that with any market, there's bad people, bad players. So you want to have really good folks. So I think we highlighted the qualified intermediary. Ryan, with your experience, and you've done so many of these, how have you experienced the other 1031? So you have the 3 property replacement rule. That's like 90-some% of 1031s.
Right. So when you ID, you have that first, everything begins from the date of the sale of the relinquished property. And as Dan said earlier, you have 45 days from that date to identify the properties that you may be exchanging into. And there are 3 rules that govern that ID process. One is the 3 property rule. The second rule is a 200% rule. And then the third rule is a 95% exception rule. As Dan just mentioned, I would say 90% of 1031s go through that 3 property rule. And what that means is I can identify any 3 properties that I want at any market value that I want, okay? So in other words, if I have $1 million at the QI from the sale proceeds of my relinquished property, I can put in 3 different properties, one for 500, another one for 500, and another one for $1 million. And I can choose any combination of those that I want to satisfy my 1031 exchange. So that's the first one. The second one is a 200% rule. Let's say that you have a number of properties that you are looking at and you just don't know which one you want to go into yet. You can identify as many properties as you want, just so long as the aggregate total does not go over 200% of the value of your relinquished property. So again, in my example, if you sold your property for $1 million, you have $2 million worth of ID, and you can ID 50 different properties if you want. I'll just mention that the 95% exception is used in only a fraction of the time. And you know what? I'm going to table it there because it's rather complicated and you just never use it. So the 3
What about,
property rule and 200 are what you need to remember.
what's a reverse exchange?
Yeah, reverse exchange is kind of how it sounds, is where you haven't sold your property yet, but you found the property that you want to go into. And so there are, there's a number of different nuances that are important to know about the reverse exchange, but I'll say simply that what happens is that your qualified intermediary creates an LLC or a trust that actually purchases that property for you while you are trying to sell the relinquished property. Now, there are still the 45-day and 180-day rules apply, but you have that ability, and we've done it a number of times where your client goes, I see this property, I want to get it, but I need the proceeds from my sale and I haven't sold it yet, so we need to do a reverse exchange.
Okay. Now we're going to jump, we're going to talk about another really important opportunity with the 1031, and that's the possibility of boot. So if you do find a property to go into for your client, then you might not get exactly the right amount of money, then you might have money left over. So you want to be able to provide, and DST provides an opportunity for you to give your clients some choices, right?
Right.
So we're going to get into, like, if you relinquish property sale was $2 million, you found a replacement property for $1.8 million, you still could put in $100,000 into a DST in one, another one in another DST. So how would you diversify the DSTs like that, Ryan?
Yeah, so this is a great example because this is probably 90% of the DST transactions that I see are the backup. They're the insurance policy. They're, and Dan's example here, if for whatever reason that 1.8 million doesn't go through, to my point about the previous ID rules, you have backups there. Or in this example where you know you have the 1.8 and you've closed on it and you just need that last $200,000 to go into to complete your 1031, this is where DSTs come in. And again, you have the universe of DSTs to choose from, and it's just vitally important to understand your client's tax scenario and of course their investment goals to make sure that you identify and invest in the DST that is most appropriate for your client. And let me put one other thing real quick is debt. DSTs play again, I think I said this earlier, just a massive role in giving you the ability to dial in the necessary amount of debt that your clients need. This is another element of when we see DSTs come into play significantly, where either, again, they can't get the amount of debt they need or they don't want the recourse debt on their individual property that they need. DSTs play a great role of filling that void.
And then you have the opportunity, like this scenario B with, again, replacement properties. You can do that. And just because of time, we're going to zoom on a little bit further. So it talks about the results of how you can get sales and commissions as well for potential commissions. So then the do's and don'ts. New asset value always must be equal or greater than the relinquished property. The cash invested in replacement property always must be equal or greater than the cash received from the relinquished property. And debt on replacement property is equal or greater than, or debt on replacement property plus additional cash is equal or greater than the value of debt for the relinquished property. So that's where you really did a great job explaining that, Ryan. Did you want to hit on that again, or we got that pretty well?
You know, I think we got that pretty good. Yeah, I think, and I definitely want to give time for questions, so we can continue to move on.
So so we're just going to get quickly into realtor benefits. Again, this is where no management responsibilities. You have no longer the toilets, trash, and tenants. You get to have the terrific teas of travel time or tennis, but the DSTs are professionally managed, and the DST distributions can be directly deposited into your account. Could you talk real quickly, because I don't think you hit that too much. To get a DST, you need to be an accredited investor.
Yep.
What are the aspects of it? What kind of, people want to know what do they get for this? What do they?
Yeah, so these are Reg D products. They are you need to be an accredited investor. That basically means a net worth of $1 million between your client and their spouse, exclusive of their home and the debt associated with that home, and or net income of $200,000 for single, $300,000 for joint, on their last 2 tax returns. It's been my experience that with the assets in the 1031 itself, 99% of clients that are doing these 1031s qualify for credit investor status simply because of the value that's associated with the relinquished property.
Okay. And did you want to talk about any of the other benefits of what the income and what you get from it?
Sure. Yeah, sorry. Yeah, so with DSTs, typically you're going to get monthly income on DST. So you're going to see a standard lease arrangement where the lessee, the tenant, is paying their monthly rent. That's coming in. A lot of times you'll see triple net lease where the individual tenants are paying for the taxes and the common area maintenance and so forth, utilities. Sometimes, like the Zurich deal that I had mentioned earlier, it's a zero coupon where you're actually having a note that is that you're paying off principal of that note every single month, and therefore increasing your client's equity in that investment every month. They are not receiving the monthly dividends from the investment, but the idea is that at the end of the term, be it 3 years, 5 years, 10 years, whenever it is determined that that property is going to sell, there is a significant appreciation event for clients at that point in time.
Okay. And then the next one for realtors is the access to institutional quality property. Again, like Inland, we can go, we have enough money, we'll go buy a $100 million apartment complex, close it. You don't even have to blink. It's all done. There's no way that you'd be able to, as an individual, have someone get into that level of kind of piece of property. It's important to know that when all the due diligences that we talked about. So that's pretty self-explanatory.
One comment there real quick, if I may, Dan, financing. A company like Inland DST sponsors, they have significant access to financing, lowering rates, increasing your client's cash on cash return. When we do the numbers in terms of comparative cash on cash return, both on a gross basis and an after-tax basis, I have yet to see another investment that can compete with a DST in this marketplace because of some of the benefits that an Inland, the institution thereof, provides.
And then we talk about lower personal liability with the recession that happened in 07, and who knows what's going on right now. You have the ability to if people have problems with their own personal finances, a company like Inland is going to be fine, and that's where people can get into. The replacement is going to be a DST, right?
Absolutely. Yep. And what's so key at the property level and the DST is those different levels of due diligence. And you look at that and you look at things like the reserve line item. I would tell you, I'm a conservative investor. And that was one of the reasons 16 years ago that I started talking to Inland because I like their philosophy in making sure that we have reserves to get through these times. This is a perfect test of their theory, and we're seeing it come out in spades where if tenants are having a hard time making the rent, they have the cash to bridge that gap, through the economic cycle.
It's a great point, Ryan. The next one is don't get sidelined. This is one of the examples of this is that realtors get a commission on the sale, and then you don't get a commission going into DST, obviously. But if you didn't have a DST, there's a lot of times then a deal wouldn't happen. We had an example in Manhattan. Somebody owned a deli, these older couple, and they had their income from the deli, but they couldn't sell because the capital gains had wiped them out. When they found out about the DST, they were able to sell. The realtor made a commission, and these folks were able to get their cash-on-cash return, and it was phenomenal. So any other aspects? Well, I guess another aspect is if I was just out at the Beverly Hills Association of Realtors, and they talked about how because of the tax laws in California, it doesn't make investments accretive. And so the idea that you're able to get someone to be able to sell because you have something for them to go into is a big deal. I don't know if you want to mention anything on this one.
Yeah, I think just in general, the 1031, I think it is a massive tool for the commercial realtors toolbook. Simply because it allows you to move inventory. I have talked to so many investors and so many realtors that say, gosh, I got this tract of land, this building, this fourplex, this apartment complex, this strip mall that my client wants to sell, but they just can't sell because of the taxes. Well, now, if you weren't familiar with 1031s, now you have that resource to say, hey, we can move this for you. And most likely, we can put it into a more productive piece of property, be it something that you find for them, or a DST that is either their primary or their backup investment. So it's a great way to get your book moving, and quite frankly, to be kind of a 1031 person, if you will, where commercial investors realize, hey, I can go to this person. They're well versed in this type of strategy, and can help me move my properties.
And then the next one is this is such a big deal for DSTs, guys. When you do a 1031 exchange, the estate planning aspect, farmers love this. Ryan, highlight the best part. Well, this is one of the best parts of this.
Yeah, so I really talk about two things here real quick, is a concept of swap till you drop, which is if you're 50 years old today and you're looking to retire and you're doing a 1031, and you do a 1031 on top of a 1031 on top of a 1031 until the end of days for you, and you've deferred all of that capital gains, you've kept your retirement income intact in a tax efficient manner, and then when you pass, as you may know, in the estate tax law, you get a step up in cost basis of the properties in your estate. So if I paid $200,000 for a piece of property when I was 50 and I die at 90 and it's now worth $2 million, instead of my heirs having to pay $1.8 million of capital gains taxes, they get a step up to that fair market value at the date of my death, which is $2 million, and they then have that property essentially tax-free. If they want to sell it outright the day after I die, they can, and they will pay very little, if any, taxes in terms of the capital gains. It is a massive benefit. And the DST, let me just target that for one moment. The ownership structure of the DST allows for very easy passing from one generation to the next. If you got a tract of land, you're trying to separate acres. If you got an LLC, you're trying to separate partnership. If you have a DST, you go in and you have 5% of that DST. And if you have two children, you separate it 2.5% each. It goes into their name and you're done. It's a very straightforward, easy process. And the heirs typically like it because it's something that they can understand, as opposed to grandpa's farm that have been in the family for 70 years.
And farmers love this, especially because they can transfer their farm wealth into generations. So it's
absolutely
a really big deal. The last thing is the insurance policy idea. So my example that I love giving is that realtors go ahead and try to find that extra piece of property for your client. But if you can't, or if you're still trying, list us as one of your top 3 choices. I was talking at the Texas Association of Realtors convention 2 years ago, and a guy comes up to me and he's like, I lost my best friend. I'm like, did he die? He's like, no, I was selling his ranch. I sold it for $14 million, and I was going to plow all that into another piece of property, but it all blew up at the last second. And so my friend had to pay capital gains. And he had to pay $4 million to the government. And he said, he's no longer my best friend. It's like, if I had a DST down, my best friend still would have been my best friend, and he wouldn't have paid any of his capital gains tax. So that's a really important thing. Right, Ryan?
Absolutely. Yeah, I couldn't have said it better. The DSTs, and I said this before, that usually they're that backup plan, that insurance policy that Dan's talking about. And I tell you, you don't need an insurance policy till you need an insurance policy. And I've been there on day 44 when something has blown up on a guaranteed closing. And all of a sudden, you got to have that DST to come in and save the day. And to Dan's point, save your clients, hundreds of thousands of dollars in taxes.
You want your word of mouth is how a lot of people get their business, and you want your clients to be saying, "Oh my gosh, what a great guy! This person was able to save me and not have to pay taxes." So these are variety of aspects of DST. I think we covered everything. Just again, these are some of the statistics of Inland and how we're really we're the #1 market share of this industry. Inland created the DST, Delaware Statutory Trust industry, and we are the leaders of it. So we appreciate your time. We appreciate you, Ryan, being an independent voice. You were terrific. And Annie, I believe, is going to see if there's any questions. So go ahead.
Y'all, there are a couple questions as of right now. One question is, I'm new to all of this. What is a Q1?
QI. Sure, yeah, I can jump in. Yeah, so the QI is the qualified intermediary, and they are essential to a 1031 exchange. And the way that I kind of relate them is, again, as a specialty title company. what they do is they work with your title. So I'm here in Austin, Texas, and Independence Title is one of the title companies here. A lot of people use them for their transactions. In a 1031, you would still use that title company. The qualified intermediary, and let's take the example of IPX 1031. They work with that title company to make sure that all the 1031 specific paperwork is done. They work in concert with them. It is always very seamless. And then once the sale process is consummated, what's so important about the QI, the qualified intermediary, is that they hold your client's money. So to comply with the rules of the 1031 tax law, your client cannot have constructive receipt. They cannot receive any of the sales proceeds from their transaction. That is where the QI comes in. They hold that money until they wire that money out on the back end of the 1031 for the replacement property purchase. Now, I say a couple things. Dan said this earlier, let me just mention, it's so important to select the QI that has E&O insurance, errors and omission, that is bonded, that is a large operation, that has credentialed and qualified professionals there. I'll mention again, IPX 1031 and asset preservation are kind of the two leaders in that industry. And I think that's kind of got it. And I would say the moment you talk to your client about potentially selling the property, that is the moment you start to find your qualified intermediary and get them involved. You've got to get them involved before the sale of the relinquished property.
Perfect.
Okay. Also, another question. Please explain QI fees, flat or percentage, and provide an example.
Yeah, that's a great question. Go ahead, Dan.
No, go ahead.
Okay, great. Yeah, so qualified intermediaries, their fees typically are around $1,000 to $1,500 per transaction. So in other words, your client sells their property, it goes to the QI, and to be involved in that transaction, to wire the funds out, it's going to cost about $1,000 to $1,500. Now, that's a pretty low amount, especially if we're talking about a $1 million, $5 million, $10 million deal. So where does a qualified intermediary make their money? Here's where they make their money. As I said before, the qualified intermediary holds your client's money. It is technically and legally theirs. It is in an account that is in their name. Now, of course, it is FBO for the benefit of your client, but it is their money, and it is sitting in an interest-bearing account. So for the days that your client, between the day they sell and the day that they buy their new property, the money is held at the qualified intermediary. It's invested in, say, a very secure money market account that in this day and age is paying 1%, maybe 2%, but that's how the qualified intermediary is making the bulk of their money. They do have that other fee to transact, but I will tell you that where they're making their money is on the interest earned from the funds that they hold for exchangers.
Okay. Also, another question. This may be more directed to Dan. From James, I've attended a couple of Inland seminars, but it seems like the primary focus of Inland is on CFAs. How can commercial realtors be more involved with Inland?
So commercial realtors could be more involved with this process by joining, by getting possibly a Series 22. If you have your Series 22, then you're able to sell these because they're securities. So you're able to get involved that way. Inland, Dan Wagner can't sell a DST because we're the sponsor. So we work with people like Ryan, and Ryan is able to work with the realtor. The other aspect of what a realtor can do is that we constantly are looking for property. And so Joe Casenza, who's in charge of acquisitions, we're always open to realtors looking for properties. Like when we purchase apartment complexes, we're looking for Class A apartments. And obviously make a commission from Inland if we purchase that. The multifamily is a big deal. Our retail is going to be grocery anchored shopping centers. We do the self-storage is another big one, student housing. So really you can broker for Inland and that way, which is terrific. And if you want to try to do sales of these, Brian, you get join your firm, I guess.
Yeah.
You could get your Series 22 and work do a pitch for your firm, Ryan.
Yeah, no, I think you hit it. I would say one thing that in the context of in the best interest of your client, you're going to need a team around you. And I always view the realtor, especially in the commercial world, as the quarterback of the team. You're going to need a team around you to do this transaction properly. With regard to having access to Inland and their DST products, my firm, Per Sterling Capital here in Austin, Texas, we are fully licensed, fully registered, and we've been working with Inland for quite a number of years. I've been working with them personally for 16. So my suggestion would be, when you decide with your client that you're going to engage or at least pursue, explore the 1031 transaction, talk to a financial advisor like myself, like the financial advisor that your client probably already has, and find out what is the DST inventory out there. Who are the sponsors that they work through? Because again, you have to be licensed, you have to be accredited for these types of investments, and you don't want to try to be everything to your client. You want to have your advisor, your financial advisor, your tax professional, potentially your lawyer on your team that you are quarterbacking for your client.
Okay. Another question. What's the minimum value of a property to get into a 1031?
So to get a fractional share interest, we talked about, usually it's about $100,000, but if there's you want to go lower than that, you can. And Ryan, people don't necessarily have to do a 1031. They can actually just invest cash, but we're talking about, from a 1031, but you can do usually about 100 grand. But Ryan, did you want to highlight anything else?
Yeah, no, usually 100 grand is the minimum. I have seen lower, but I would say this, and again, you've probably gotten the impression from me that I'm a rather conservative investor. Again, my clients, they talk to me about preserving their capital and then making money on it. Don't get into risky investments. So the investment grade DSTs like Inland Capital out there, they usually have that $100,000 minimum. You want to look at that. The ones that are lower, you really need to do your diligence on the quality of the investment that you're getting into.
Any other, Annie?
Yeah, I'm just responding to someone asking about Ryan's information.
Yeah, I'll throw it out there real quick. Again, we're in Austin, Texas. My firm is Per Sterling, P-E-R, second word S-T-I-R-L-I-N-G. We're here in Westlake, Austin, Texas, and again, I lead the group for the 1031 exchanges, and we've actually put together a process that we work with realtors. We call it the intelligence dividend process, where we really work with you and your client to walk you through the entire 1031 exchange transaction that we've talked about today, from engaging with the QI through understanding the ID process and actually identifying in the appropriate manner to make sure that you have satisfied all the 1031 rules, and then the diligence. I think it's so important, the diligence on the investment, be it a DST or something else, that is appropriate for your clients. And we would welcome any questions offline that you may have.
Yeah, okay, so we have another question. I've attended a couple of Inland seminars, but it seems like the primary focus of Inland is on CFAs. How can commercial realtors be more involved with Inland?
Well, as I said, if realtors want to broker and bird dog properties for us, they get commissions that way. So that's how they can contact me at Inland at Dan Wagner at 630-218-4953, and we can talk to them. But that would be the suggestion, how they can do it. Or otherwise, if you really are interested in this whole idea as a career, working with Ryan, he can explain to you how you actually can become a part of what he does.
Yeah, and I would simply say, if that's something that is of interest to you, please do reach out. I think that we're going to have the opportunity to reach out to you after this presentation, and I believe Annie will be sending out the slide deck, and Annie, feel free to include my contact info on that.
Okay.
Absolutely. Okay, yeah, people have reached out saying that they want our contact information, so I'll send that along.
Great.
We love Texas. I want you to make sure you know that. We own a lot of stuff in Texas. Texas is a great
Well,
state.
thank you all for, doing this today.
We are honored to be able to do this. And again, for realtors, this is another opportunity for you. It's another tool for your toolbox. Not every client's going to do a DST, but now you understand more in depth about how to do it. Ryan is a good go-to guy to help you go through this process. And we can't tell you how much we appreciate it. Annie, how many people did we have on today's webinar?
59.
Wow.
We had,
Just, not bad.
it's great. So 259. We thank you so much.
Yeah, thank you guys.
Thank you for the opportunity.
Yeah, thank you so much.
God bless you, realtors. Stay safe.
Yeah.
Bye-bye. Thanks.
Bye-bye.